Okay, how do I make a video about the state pension interesting? So this is hopefully going to be punchy, maybe fun, but I'm going to tell you what you need to know about the state pension. So buckle up for a quick fire bit of info, some unnecessary graphics, and welcome to State Pension Explained. All right, here we go. So what is a state pension? So a state pension is basically a pension payable by the government once you reach a certain age. When you're eligible to take it, it's payable for the rest of your life, regardless of how long you live. There's also buying power protection, so it increases each year to keep in line with inflation. Currently, that's protected by what's called the triple lock, which is the higher of the increase in earnings, price inflation, or 2.5. Why is that important? Well, let's say prices or earnings don't increase at all for 10 years. You'd still get 2.5% increase on your state pension. If that happened each year for 10 years, which come on is extremely unlikely, but bear with me, there'd be a 28% difference between the state pension value and those prices. Now that's an exaggerated example, of course, but it's just to highlight the potential value of the triple lock and the component parts that can potentially drift and what that can mean. So the full level of the state pension is £179.60 a week in year 2021-2022, which produces an annual income of £9,339.20. The amount you get may be lower, as your entitlement to your state pension depends on your national insurance record. Though you're entitled to it at a certain age, you won't qualify for the state pension automatically. You have to claim it. So, when do I get it? Hurry up, pretentious graphic. Okay, the new state pension is payable regardless, well, as long as you've met the minimum contribution requirements of 10 years. You can check when you're due to get it in this link, which I'll put in the description. If you retired before 2016 and you're on the old system, there are details on that in the description. Sorry, it's too complicated, too many things to explain. Go on that. In November 2018, the state pension age was 65 for men and women. However, this is gradually increasing, and it will reach age 67 by 2028. Under the current law, the state pension age is due to increase to 68 between 2044 and 2046, but this could all change. And if you're watching this and you're younger, just be aware it's probably wise to think they might push it back further, but who knows? Okay, so how does it work? Well, the amount of state pension you get is based on your national insurance or NICs. If you haven't made enough contributions, then you won't get the full state pension, but you may be able to pay voluntary contributions to boost the amount you get. So the amount of state pension you get is based on the number of qualifying years of national insurance contributions or credits you've got. To get one qualifying year, you need to have enough national insurance contributions for the financial year in question. And a financial year runs from the 6th of April to the following 5th of April. So each year on the new state pension system gives you 1/35 of the full amount. For example, 35 years gives you 35 35ths. 30 years gives you 30 35ths, and 10 years gets you 10 35ths. Make sense? Here's some numbers. Okay, so how much do you need to earn to meet the contribution threshold? The lower earnings limit, which is for employees, is £128 per week or £6,240 per year. For the self-employed, it's £125 per week or £6,515 per year. You can also get national insurance credits if you're, for example, looking after a family, if you're a carer, if you're seeking a job, and further details on eligibility for this in the description, so have a look. Okay, on the 6th of April 2016, the new state pension system, or the single-tier state pension, was introduced. So state pensions under the old system were made of two parts: a basic state pension, which you'd received in full if you had 30 qualifying years of national insurance, and also an earnings-related element, often known as a state earnings-related pension, or SERPs. Some people could opt out of the earnings-related part of the state pension, and this was called contracting out. What that meant is that you paid lower national insurance contributions, and instead you contributed to a company scheme or a personal pension. If your state pension age was on or after the 6th of April 2016, you get the new flat rate state pension, and to receive this amount you need 35 qualifying years of national insurance or credits. And here's the crucial bit: if you were contracted out for any period in the past, there was a one-off deduction to take account of it at that point. So what does that mean, boring finance guy? Well, it means if you've been contracted out, you could have a lower accrual in your state pension as it's been accounted for elsewhere. So check. So let's talk about what you can do, or topping up. If you do have gaps, and I underline it may be worth topping up your state pension, as it's generally good value for money. So look, the rules for topping up your state pension are complicated. But if you can afford to make voluntary Class 3 national insurance contributions, the rewards can be quite large relative to the cost. There's a booklet in the description which explains this a bit more. But I think the big question you need to ask is, do you need to? Are you going to build natural accrual through, for example, working? Do you actually have any gaps? And is it affordable to do so? So, for example, if somebody retires at 60, but they might change their mind and go back to work at 62, they may want to consider holding off, as they might have natural accrual through their income if they go back to work. And what do I mean by that? Well, the standard cost of buying Class 3 national insurance contributions is £15.40 per week for missing contributions for year 2021-2022. So that means it will cost you £880.80 for an entire year. And this will boost your pension by £4.80 a week, which sounds rubbish, but that's £250 a year. So now think about those annual figures. It actually means that you'd only have to live past 3 years past your state pension age to recoup the money. And every year thereafter, you're getting that guaranteed triple lock protected income afterwards. But you absolutely need to check the rules and your own situation, or get advice specific to you, as it can be tricky. So let's talk about tax and deferring options. So the state pension is taxable, but it's paid before any tax is taken. What this basically means is that although tax isn't deducted from the state pension, it will use some of your tax-free personal allowance, which this tax year is £12,500. So the state pension is treated as earned income, so it's taxable, but there are no national insurance contributions payable. You can also defer the pension, and if you wait for a full year of deferring it, it's an increase of 5.8% per year. So again, it really depends on your own personal situation, when you are retiring, and your income structure. So I hope you enjoyed that. Let's be honest, it was a video on a state pension. I can't make it that interesting. Could I have put more unnecessary graphics in? Maybe I could. Could it have been more interesting? Maybe it could. Anyway, I'm rambling. This has been Principles Personal Finance. I appreciate you watching. See you next time.